Iran's Revolutionary Guard just publicly named Nvidia, Apple, and other major U.S. tech companies as, quote, legitimate military targets. Let that sink in for a second. We are no longer talking about abstract geopolitical risk in some faraway region. This is a direct threat aimed at the companies sitting at the heart of your portfolio. And here's the twist. Despite oil pushing gas to $4 a gallon, Wall Street is now betting the Fed cuts rates, not raises them. If that sounds contradictory, stick around because today I'm going to untangle exactly what's happening and what it means for your money. Welcome back to Daily Market Breakdown. I'm glad you're here because today is one of those days where the headlines are moving faster than the algorithms. We're breaking down three critical stories. First, Iran's direct threat to U.S. tech giants and what that means for mega-cap risk. Second, the counterintuitive case for Fed rate cuts even as gas prices spike. And third, whether the historical playbook says markets are about to bottom or break down further. By the end of this video, you'll have a clear framework for protecting your downside and spotting the opportunities hiding inside this chaos. All right, let's get into the facts. It has now been roughly 1 month since the Iran conflict escalated into open hostilities, and the damage across asset classes has been, in a word, turbulent. Stocks, bonds, commodities, everything has been whipsawing. CNBC's latest reporting lays it out clearly. Assets across the board have been volatile since the war began. Now, on top of that baseline instability, we got a bombshell this morning. Iran's Islamic Revolutionary Guard Corps, the IRGC, has issued a warning to a number of U.S. tech companies with Middle East operations, including Nvidia and Apple, that they will be considered legitimate targets. Folks, this is not a vague diplomatic statement. This is a paramilitary organization with real operational capability making a direct threat against specific American corporations. Meanwhile, on the energy front, gas prices have pushed toward $4 a gallon. But here's where it gets interesting. CNBC is reporting that Wall Street commentary has actually shifted back toward expectations for Fed rate cuts, not hikes. The logic? Higher energy costs act like a tax on consumers, slowing demand, which is ultimately deflationary for the broader economy. And then we have Fundstrat's Tom Lee making the case that stock markets historically bottom in the early stages of military conflict. He points out that adjusted for inflation, oil prices are still less than half their 2008 peak of $144 a barrel, and his technical indicators suggest risk assets may be primed for a bounce. Now, let's break down what all of this actually means for you as an investor. Think of the current situation like driving on a highway in a sudden thunderstorm. You've got three things happening at once. The road is slippery, meaning geopolitical risk is making every asset class harder to navigate. Your windshield wipers are on full blast, but visibility is still low. That's the uncertainty around Fed policy. And there's a detour sign ahead that might actually lead to a shortcut. That's the historical pattern Tom Lee is pointing to. Let me walk through each layer. First, the Iran threat to tech companies. This is not just a headline. It introduces a new category of risk that markets have not fully priced. We're talking about companies like Nvidia and Apple that have supply chains, data centers, cloud infrastructure, and enterprise clients across the Middle East. Even if no physical attack occurs, the threat alone can trigger insurance repricing, operational pullbacks, and customer hesitancy in the region. It's like when a restaurant gets a health scare. Even if the food is fine, customers stay away for weeks. That's the overhang. Second, the Fed and gas prices. This is where most people get confused. You'd think $4 gas means inflation is raging and the Fed has to hike. But the Fed looks through supply-driven price shocks. Think of it this way. If your heating bill doubles because of a cold snap, you don't get a raise at work, you just spend less on everything else. That's demand destruction, and demand destruction is deflationary. The Fed knows this. That's why the smart money is now pricing in cuts, not hikes. The war is actually creating the economic slowdown that gives the Fed room to ease. Third, the historical pattern. Tom Lee's argument has real data behind it. Markets tend to sell off on the uncertainty before a conflict and then stabilize once the situation, however ugly, becomes a known quantity. The Gulf War, the Iraq invasion, even the early days of Ukraine. In each case, equities found a floor within weeks of the initial shock. Now, does that mean we're guaranteed a bottom here? Absolutely not. Every conflict is different, but the pattern is worth respecting, especially when technical indicators are lining up alongside it. Let's zoom in on the two names at the center of today's biggest headline, Nvidia and Apple. The IRGC specifically named these companies in its threat. Now, our data feed today doesn't include specific price action or volume for NVDA or AAPL, so I want to be transparent about that. I'm not going to invent numbers. But here's what we can say based on the news. Nvidia is the backbone of the global AI infrastructure build-out. Any disruption to its operations, supply chain, or customer confidence in the Middle East adds a risk premium to a stock that's already trading at elevated multiples. For Apple, the story is twofold. Not only is it named in the IRGC threat, but separately, Apple is facing criticism for its crackdown on AI-generated apps, which some commentators say puts it on the wrong side of the AI revolution. So Apple is dealing with a geopolitical threat from the outside and a strategic question from the inside. If you hold either of these names, and statistically most of you do, whether directly or through index funds, this is a moment to reassess your position sizing. I'm not saying sell. I'm saying know what you own and make sure your exposure matches your risk tolerance in a wartime environment. All right, here's my personal take. My bull-bear score today sits at 4 out of 10, leaning bearish but not in panic territory. Here's why. The base case, which I'd put at about 55% probability, is that markets grind sideways to slightly lower over the next 2 to 4 weeks as the Iran situation remains fluid, earnings season approaches, and the Fed stays on hold. The risk scenario, maybe 25% probability, is a sharp escalation, an actual attack on corporate infrastructure or a major oil supply disruption that sends equities down another 8 to 12% and gold surging. The upside scenario, around 20%, is a diplomatic breakthrough or ceasefire that triggers the kind of relief rally Tom Lee is positioning for. So what do? Number 1, do not panic sell into headlines. Number 2, consider trimming overweight positions in names with direct Middle East exposure. Number 3, make sure you have some dry powder, cash or short-term treasuries, ready to deploy if we get that washout. And if you're newer to investing and want to practice managing risk without real money on the line, check out Webull. I've got a link in the description where you can paper trade and get up to 12 free stocks just for signing up. It's a great way to build discipline in exactly this kind of environment. All right, folks, let me leave you with this. Today's market is telling you one thing loud and clear: risk management is not optional, it is the strategy. The headlines will keep coming, the volatility will keep swinging. But if you stay informed, stay sized correctly, and stay disciplined, you will be in a position to capitalize when the dust settles. That's the edge. Manage your risk, and I'll catch you in the next one.